What's going on, everyone? The trend continues this week with active listings up again from last week, despite the higher interest rates, plus some interesting news about the trends in mortgages and the housing market that continue to suggest the market is cooling, despite the mainstream media's insistence on the market continuing to accelerate. So you're not going to want to miss these stories coming up in today's market update. So let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. So if you're new to this channel, welcome, and if you haven't already done so, please consider subscribing to the channel and hitting that bell so you don't miss out on the data, tips, and analysis keeping you ahead of market trends. So the uptick in active listings on the market continues, but by how much? We also got new CPI and Ppi data last week that we need to talk about because I think the mainstream media is missing some key information in their predictions. And there was more news this week detailing a cooling down in the housing market. So let's get started with the week over week local market data. All right, so in today's 7-day market update, we went from new listings last week at 952 to 817 new listings this week. Although that's down 15%, it actually is still quite a bit higher than what we have been seeing over the last few months. If you go back to January, February, and even the early parts of March, 817 new listings coming on the market is still higher than what the averages were during those months, which was somewhere between 600 and 700 new listings. So even though it's down 15%, it is still up for the year and the averages over the last 2 years. Solds went from 997 to 901 this past week. That's down 10%, which is showing that the amount of homes going and actually closing is still dropping a little bit. It's still quite high. But then we go down to the pendings. We went from 1316 last week to 1191 this week. That's also down 10%, which means less homes are going off the market and actually closing. So that is showing that we are still getting more new listings on the market. And you're going to see that right here in this next slide. Single family homes, last week we're at 2326, which has still been increasing. And this week we were up to 2382. So that's a gain of 56 new listings for single family homes on the market currently. So that's up again. Condos went from 1202 last week to 1247 this week. That's up 45. So the net gain last week that we're comparing to was a gain of 234. This week, we only have a gain of 101, but still that is another gain of active listings on the market. Now moving into this multifamilies, we went from 106 last week to 104 this week. So that's 2 less than what we had, but still over 100. If you remember back in February, January and February, I think our averages for multifamilies was somewhere around 70. So now that we're still staying in the hundreds, that is a good sign, and that means that more active listings are on the market currently. Foreclosures, again, not too much movement this week. We went from 39 last week to 38 this week. That's a loss of 1. We still haven't really seen any significant uptick in foreclosures. It's really been hovering right around this area. So despite what people have been saying about some kind of a foreclosure wave coming, we haven't seen any signs of that in any of the recent data that we've been looking at. Interest rates, as of this week, interest rates went from 4.994 last week to 5.166 this week. That's according to NerdWallet, so that is up almost 17 basis points. Bank rate has the average going from 5.06 to 5.07, so not a significant increase, but both NerdWallet and Bankrate are pretty close to each other on the average mortgage rates for a 30-year fixed mortgage as of now. So that's good that they're both on the same page, but still quite significantly higher from the 3 percentage points that we were seeing just about 3-4 months ago. All right, let's get into the headline highlights. So we got 4 big stories for you this week. 2 of them were actually from Tuesday and Wednesday of last week, and I had mentioned that in my last video, the CPI and Ppi data. A lot of people are saying that we're going to be seeing peak inflation, or we're already seeing peak inflation. I think that they're missing out on some key data in those predictions, but let's take a look and dive right into this story. So for CPI for all urban consumers increased 1.2% in March. The increases in the index for gasoline, shelter, and food were the largest contributors. I think we're going to see gasoline has really started to level off a little bit with Biden opening up our reserves and releasing 1 million gallons per day. So I think gasoline is probably going to be hovering right around where it is, at least down here, around the $4 mark. Shelter and food are still increasing, which I think is going to be the contributing factor to still seeing inflation increase in the coming months. The gasoline index rose 18.3% in March and accounted for over half of all the items' monthly increase. The food index rose 1%, and the food at home index rose 1.5%. I don't know where they get those numbers from, because I personally, I feel like I know that the grocery store has risen a lot of the food items that at least staple items that we're always buying, at least 25% from what we've been purchasing. Our food bill has gone up quite a bit. So I'm sure a lot of you are feeling the same, but according to the numbers, we are only seeing 1% food inflation at this time. Now let's dive right into the actual charts. So all food items, the unadjusted 12 months ending in March, are up 8.5%. So we're seeing an 8.5% inflation rate. I had mentioned that's where I thought we were going to be coming in at, and the prediction was correct. So still a little bit higher than what they were predicting. I think they were predicting right around 8.3 or 8.4. So 8.5 was, a decent amount higher. Food, 1%, as you can see. I'm not sure how, as I said. Energy, 11%. That was due to the increases in oil prices. And then fuel oil, you can see 70.1% year over year. So that is a huge jump. And again, I think we're starting to see it level off a little bit right now, but we'll have to see how the war and the tensions in Europe will play out with that. Moving on, just the second page, really. One of the things that I thought was interesting was that the new vehicles only up 12.5%, whereas used cars and trucks are up 35.5 percentage points year over year. So those are some really large increases, and I think that's going to contribute to the continued inflation. But the real leading indicator, so the CPI is a lagging indicator. The real leading indicator is the PPI, which is the producer price index. That's the next story here. The rise in the PPI was led by a 2.3% advance in prices for goods. Services increased 0.9%, and then prices for final demands, less food, energy, and trade services moved up 0.9% in March, the largest advance since rising 1% in January 2021. For the 12 months ended in March, the index for final demand, less foods, energy, and trade services increased 7%. So this is where I said, this is the leading indicator. If PPI is still increasing 2.3%, I'm pretty sure we're going to be seeing inflation continue to rise, just because this is the leading indicator. That means that the CPI still hasn't caught up to this yet. If producers are continuing to raise the prices of things, then we're going to continue seeing the inflation rise. So I'm not sure where some of the predictions are coming from as far as we're seeing peak inflation. As long as PPI continues to inflate, we're going to see CPI as a lagging indicator inflate as well. Here is the chart for the PPI data. As you can see, this goes all the way back to March 2021, a year ago. The significant indicators here are foods. January is 1.8, February 2.1, and then March 2.4. So you can see that it's been steadily increasing at a 0.3 percentage rate increase. From 12 months ago, so 11.2 percentage. This is where I'm looking at the chart the most, is that if you look at January 2022, 12 months ago, unadjusted was 10.1. And then you're looking at the next month, 10.3. So that's up 0.2 percentage. And then we go to 11.2. So that's up 0.9. That's quite a significant adjustment from February to March. So I think that's indicating that we're going to continue seeing inflation rise. And producer prices are going to be passed on to the consumer. So expect prices to continue rising for quite some time now. All right, next story. Mortgage rates jump above 4%, prompting borrowers to return to a staple of the housing bubble. This is actually an older article. It came out at the end of March. I'm just covering it now because I'm starting to see that this is something that is happening more and more frequently, especially now that interest rates are going over 5%. The share of mortgages that are adjustable rate mortgages, which are ARMs, doubled to 10% in January, up from a 10-year low of 4% in January 2021, according to CoreLogic. ARMs offer an initial low rate for a period of years, typically anywhere from 3 to 10 years, and then the rate adjusts after that. So the main concern for this would be, even if it's a 3-year intro rate at, let's say it's 4 percentage points or so, I think that's where they're at right now. So you'll have 4% interest rate for those first, 3 years or so, maybe a little bit longer. The problem with this is that so far, even the Fed has been predicting that inflation is going to be lasting longer. Now, the only thing that is possibly working in favor of an ARM is that the market, at least right now, is priced in that the Fed is bluffing with the interest rates. So the market, at least, is predicting that the Fed is going to raise interest rates a little bit to put on the face that they are trying to fight inflation. In reality, they're not going to. They're only doing that so they can give themselves some room to lower rates again. And that's going to cause some issues. It's going to cause either stagflation or deflation in the very near future, and then in the longer term future, potentially hyperinflation, which is something that people like Peter Schiff are concerned about. So if that does happen, then ARMs probably, the interest rates probably won't go up too much. So an ARM might actually work in your favor in the longer term. But in the short term, if you've already got an ARM, this is something to consider. If interest rates do go up in the short term, maybe either refinancing out of it to something that's fixed, maybe a little bit higher interest rate, so you don't have to worry about those ARM rates going up quite significantly. So just something to think about for the future. ARM activity rising in response to rates. So Mike Fratantoni is revising MBA's mortgage forecast. He is now calling for mortgage originations to total 2.58 trillion in 2022. That's a 35% decline from 2021. So this is just showing you that mortgage originations are actually declining quite significantly, which is leading to layoffs throughout the mortgage industry. A 4% increase from 2021. Refinance originations are now expected to fall 64% to 841 billion. So 64% is a huge drop, and that is why a lot of these companies like Better.com have laid off a huge portion of their workforce in just the last several months alone, and I believe there will be more in the near future. Home sales fell 4% in March as buying costs shot up. So this is a report from Redfin. This is the most recent one. They had already mentioned that home sales price decreases were starting to increase. Now home sales actually fell 4% in March as buying costs shot up. Just to put it in perspective, though, in March of 2022, the median sale price is $412,700. Month over month, that's a 6.2% increase, and year over year, that's a 17.3% increase, which is why I'm a little bit confused as to why the housing isn't playing a larger part in inflation, because it continues to skyrocket, and we're not seeing those numbers really affect the CPI as much as I would have expected them to. All right, moving on to the next one, housing market update, demand slips. So that's another, not really a surprise, pushing more sellers to drop asking prices again. This is going on the back of the last one. The last report did already mention that home prices were starting to slip, but this is a new one, which is actually showing that it's increasingly slipping. Early stage home buying demand continues to falter this spring as new listings fell 7% from a year earlier. Fewer people search for home sale on Google. That's down 3% from a year earlier. And then the Redfin Homebuyer Demand Index, a measure of requests for home tours and other buying services from Redfin agents, has also declined 3% in the past 4 weeks compared to a 5% increase during the same period last year. So the index was up 2% from a year earlier, but we're seeing the demand slow, which is showing that the market is slowing. Just to continue with that story, touring activity. A few other data points. Touring activity from the first week of January through April 10th was 23 percentage points behind the same period in 2021. That's according to Showing Time, which is one of the leading showing instruments that agents use. Mortgage purchase applications were down 6% from a year earlier, which is no surprise. And then 30-year mortgage rates rose to 5%, the highest level since February 2011, and the fastest 3-month rise since May of 1994. So that's the last 20 years, 25 plus years. This is the fastest rate that mortgages have risen. Okay, last thing, the wall of worry. So there are a few changes to the wall of worry this week. The recession or inflation. As of right now, the Fed is really in a tight spot. They have two choices, really. And one of them is to put the economy into a recession, because the typical phrase is the cure for high prices is high prices, to let the market correct itself. When prices rise, people will spend less, and that forces prices to actually come down. The other choice that they have right now is to save the market, keep the economy going, keep the stock market going and the housing market going, which would increase inflation. The market is predicting that it's going to be somewhere in between those two things, but eventually lead to inflation, which would be that they're going to raise the rates a little bit like they always do, and then they're going to drop them again even lower, which would put us probably at a 0% interest rate for the Fed. When they do that, though, that is going to lead to more inflation. They're going to have to stimulate the economy somehow to keep it going and keep the boom going. Michael Burry has just recently, in the last 3 days or so, put out a tweet basically calling for what's called a crack up boom. So it's going to be something where exactly what people are predicting they're going to do. They're going to raise the rates a little bit to give themselves some rooms to actually lower them again. When they lower them again, they're going to be forced to stimulate the economy somehow to keep the boom going, the housing boom, as well as the stock market boom. But what that's going to eventually lead to is hyperinflation. And the big worry for the crack up boom is something like the currency being completely devalued, which, depending on what you've been listening to, would play into the idea of the Great Reset, and a lot of other people calling for the currency to be switched into some kind of a new monetary system. The other one, 50 basis point hike in May, that's supposed to be coming. The Fed seems pretty hawkish on it still, although, we'll have to see if they actually go through with it. If that does happen, that could lead to a bit of a recession. Not necessarily guaranteed, but the risk is rising as we continue moving forward. And that would lead to job losses, which would in turn affect the economy in a variety of ways. The global food crisis, there are a few different things going on right now. Wheat, obviously, and fertilizer in Ukraine and Russia, that's a huge hurdle right now with the supply chain issues and the disruption of the war that's causing on the planting season and harvesting in the future. We also have a huge bird flu epidemic going on right now between chickens and turkeys. I think there was over 24 million chickens and turkeys were killed. Not just by the bird flu, but when a flock does catch the bird flu, they usually have to cull the entire flock. So it's leading to, it looks like poultry prices will be going up in the future due to this as well. Ukraine tensions escalating. According to the Russian state media, they are actually considering what's going on right now, kind of the beginning steps of what they're calling World War III. At least that's what their propaganda is saying there. The Navy ship that was just sunk, they're considering this whole thing to be a war against NATO and NATO encroaching on their territory. So we'll have to see if, how that plays out. And the final thing is consumer credit. This is just something to keep an eye on still. Are the consumers raising the amount of credit that they're borrowing to keep up with their lifestyles, as well as what they've been purchasing right along with their assets? Are they turning their assets into liabilities by overextending themselves and over leveraging themselves? So, but this is just what I think about the market. So please, in the comments below, tell me what you think, and I hope to see you guys in the next one. Thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swfl.com. relocationteam.com. Thanks again for watching to the end, and I hope to see you next week.